For traders that have asked, the free downloads are available in the link below in the description box. The 4-step method to high-performance trading. A high-performance trading mindset is critical for increasing confidence and your ability to execute your trading edge in live time. And the 7-step daily routine for high-performance traders is about bulletproofing yourself with your daily habits to build discipline, confidence, and a winning mindset to master the markets. Again, that link is down below in the description box. They're free downloads. Let's get started. Today, trader Stacey Burke from Stacey Burke Trading. A lot of questions about certain setups and traders still struggling to identify when their best setups or what their best setups are in terms of entering the market at certain highs or lows. Coming back to understanding the timing of everything is critical. We talked about this in most videos, but those 3 12 candle windows are targeting around the equity market opens of Asia, London, and New York, and specifically the high and low of the day. Now, we talk about the high and low of the week and understanding day 1, day 2, day 3, and they're not going to give you, a cookie cutter template every week. And so one of the things I think traders struggle with is they go to the screen trying to figure out what an instrument's going to do and then try to trade it, as opposed to just, again, scrolling through and looking and identifying an instrument that potentially is at the high or at the low, day 2, day 1, day 3, for a reversal trade, or even in the pre-market, prior to the equity market's opening, a trend trade. Often the trend trades are the explosive moves prior to the equity market opens, because remember, the smart money, the institutions, market makers, whatever you want to call them, they trade in both directions. Now, there's an underlying bias, perhaps, to where they're going to move the market in a longer-term direction or over the course of the day and the week. But that does still creates the opportunities for us to be trading when there's an ideal setup. There could be a counter trend trade for 50, 100, 75, 25, whatever that is, in that session window that you're available to trade. Great question from a trader. Why I took a trade last night on my nighttime, northern hemisphere, the daytime, shorted the M up top, and now these are 250 pip boxes on the S&P. And if we just tighten this up to have a look, we can see that those high of day, the previous high of day was in place, but we have 250 pip increment boxes. And the question came up, why didn't I short the M in that first part of the window? And again, critical, especially for a U.S. index, 9:30 a.m. New York Eastern Standard Time. Now, whether it's summertime, wintertime, another question again, does daylight savings time affect it? For me, I stick to New York time year-round. New York time, people say, well, then London doesn't change for a few more weeks after, and I still focus on New York time. You'll be amazed at how, again, the market is going to move sometimes in the first hour. It might move in the middle hour, and it might move in the third hour. But I stick to New York time. My belief, my study, my conviction to this is that the algos, the big players, whatever they are, they move on New York time. Now, we had advanced GDP, and that created a peak formation low after the news. They came back up. This is prior to New York opening. And they made the little double top pattern, which, again, this is prior to the market opening, which is why timing is so critical. This is a dead giveaway that's a trap. If you short a double top, and again, the market is in an upward move, and this is prior to the market opening at the equity hour. But this creates the higher lows. This is what we want to see. We want to see traders getting caught chasing the move up into the open of the New York market session, and it goes vertical into the open of the equity market, pulls back and retests that upper level. Now, if I change my sweet spots indicator now to my major round numbers within that 250 pip box, we can see we're in the upper third between 50 and 75, right at the open after 3 levels of rise. And so my thesis on all of this is always, I don't try to get in at the high. I know traders have said, why didn't you sell it here? Traders ask, why didn't you sell the M here? And that's timing. This is specifically for timing. But why didn't I sell it up here? Because the market could continue to go up. I'm not trying to cherry pick the top and the bottom. There are instances where you could put a starter position in at the high or the low. This is not one of them, and I don't like to do that with either the indexes, the NASDAQ or the S&P. But when the market came back down inside, that changes my thesis. So again, I'm underneath now, and I always like to know or have a thesis that the high is locked in place. Now, I've talked about adding in certain trades, and this little window between the swing low and the breakdown, once they pin up into that breakdown, the M structure. This little window in here between the numbers is where I'd be looking to add size into the trade. And if it accelerates underneath of the bull candle, again, I will add positions, because the bull candle, now what they're telling me is they're pinning back up into this. That's locked in. This is all trapped. This is the low-hanging fruit on the way down. And traders who have gone long after the news are likely a probable target. Now, when I was in this trade, I'm thinking 3 levels of 50 as a minimum. So we talk about 3 levels of rise or fall. This is a 300 pip box. I'm looking for minimum of 150 pips on the way down, which takes us back just after the news, underneath the double zeros, for a fast, explosive move with very little stress. So again, just emphasizing that timings are critical. Oil, NASDAQ, S&P, gold not so much, but it can react at the New York Open. Often we'll see a move in that first hour, but when there is news on the calendar, I will always look for the New York Open to either have an opportunity for simple trade setup or a continuation, whatever that may be. But this was a high of the day opportunity that was, even though the market continued to go later back up in line with the longer term trend, this market gave a great high of the day trade opportunity right after the open of the session. The Japanese yen, day 1, day 2, day 3 on Wednesday, 3 days of rise. The Fed sells off and gives us our first red day. This is a textbook first red day against the downward move from the previous week. Day 1, day 2, day 3, first red day. So Asian session traders again had the opportunity for an explosive first red day trade. Now this is textbook again, where the market still gave traders the 3 peak formation: London, Asia, London, and then New York entry for the continuation of the move down in line with the first red day trade. Now, I know a lot of traders took the pound yen as well. And you'll notice there's a variation in how the pound yen traded. It blew off in the direction of the Fed. So if we just back this up a bit, take a look. Day 1, but no longs triggered into the market at the break of the previous day's high. Day 2 pulls back inside, an inside day. Day 3 breaks traders long on Fed day, and it blows off in the direction of the trend on day 3, back to the high of the previous week. So again, traders who were on top of that had an Asian session trade for high of the week, high of the day, high of the session on the half Batman formation. And again, with the yen having first red day, you can see again that London gave a high of the session trade in line with the breakdown and the target being, somebody asked me, what do you mean by target? The high and low are always the targets. That's where the money is. And so if you're getting caught down low, I'm looking for a short squeeze. If they're bringing it up high, I'm looking for the market to lock in the high and revisit the low, whether it's the low of the session, the low of London, the high of Asia, whatever that may be. But we break down, and again, there's our 1, 2, 3 just prior to the U.S. session. 1, 2, 3, engulfment sideways, and then the continuation move for a 100 pip drop through the low of the week, or through the low of Tuesday. So timings are critical, but just sticking to simple patterns. Like I like to short. I think that's pretty obvious now. So I'm always looking for stuff that's gone up to the high. Oil was a great opportunity. Again, day 1, day 2, back inside on day 3. There's our classic inside bar pattern, even though not technically an inside bar. It triggered the low of Tuesday. But day 1, day 2, longs in the market. On Tuesday, we have longs triggered at the break of Monday's high, and they take it back up on the Fed. And then on Thursday, 1 push, 2 pushes, 3 pushes right into the open of the New York session on the third level of rise. So again, in our new 100 pip box, they take it up 3 levels. We get 3 pins right at the New York equity market open, the oil market as well, for a sell-off at 50. Now, one of the things with oil is that often it can move in other sessions. But again, if we just come back to looking at instruments that have broken a previous day's high or low, it keeps me out of lower probability situations. I'm stepping back and I'm looking for stuff where there's an opportunity at the high of the day or the low of the day when the equity market's session timing starts. So when you're inside of a market's high and low. So for example, if we look at gold, now gold has broken the previous day's high. So we have longs in the market, but we've come off the low of the week on Wednesday, and on ADP, they take it to the high of the day. Now, important to understand that if you counter trend this move after the news, shorting it back down from the high of the day, it's important to look at the overall bigger picture. So if we look at the 4-hour chart, beginning of July, we start week 1 down, week 2 down, and then week 3 down last week. We pull back and we close as first green week, and then day 1, day 2, day 3, Monday, Tuesday, Wednesday, for the short squeeze reversal. So we've come back to the highs of the previous week, taking out the highs of the previous week, as well as the second week of the month. So the same principles apply. Week 1, week 2, week 3. First green week, 1, 2, 3 down, day 1, day 2, day 3, Monday, Tuesday, Wednesday, and the reversal day. So traders that may have counter-trended this move, which was still a great setup high of the day, triple top, right at the end of the first hour, had the opportunity for somewhere in the neighborhood of 40 to 50 pips. But then we get 1 push, 2 push, 3 pushes, and the reversal right at the end of the first 15-minute bar of the middle hour, in line with that trend back in the long direction on the longer time frame. So ADP takes it up, gets traders selling into that move from the news, and then the market works its way up into the New York Open, taking out the high of the week, high of the day, the session, etc., moving back up in that long direction. So traders that were long, we have an opportunity for 75, 100 pips, possibly back in the long direction. Traders that were shorter in that neighborhood, 35 to 50 pip area, again, locking in the money, take the money, get off the screen. If you're trading short, be aware that you're shorting into that underlying bias to the long direction. Again, take the money. And evidenced of this 1 push, 2 push, 3 push reversal. 1 push, 2 push, 3 pushes into the peak formation high, peak formation low, trend the market. So keep it simple, traders. Focus on what you understand and trade the best. They move it in both directions. There's opportunities long and short. And as I said, I'm biased to the short side, but keep it simple. Again, thanks for a ton of great feedback. I appreciate the best wishes. Do my best to continue to answer as many questions as possible, but focus on what's simple and what you understand and trade the best. Have a great session today, and may the markets go with you.